Frank-Holmes of U.S. Global Investors joins me now from the New Orleans Investment Conference. Frank is also a speaker here at the show. Frank, thanks so much for being with me.
It's great to see you again.
All right, well, I'm excited to talk about this next topic with you because it's the number one question from my viewers, and it's regarding gold stocks and why they haven't been performing as well as gold. And you have an interesting theory here, and you say we might see a change happen now.
I do believe that there's going to be a change in the capital markets regarding gold mining companies. I look for, life's all about managing expectations. Yes. And too many of these executives have made promises and forecasts that have not delivered. So the average gold mining company has forecast that they're going to increase their production every year by 10%, and it's been actually -2%.
That's an interesting statistic, -2%.
And their costs and their acquisition costs, when you take a look at it, they've been diluting their production per share, their reserves per share, and their margin costs have been rising. So right. I think that when you have a tipping point, like Malcolm Gladwell wrote the book, there's a tipping point that things are significant. And what's significant is the CEO of Gold Fields coming out with a white paper back in July regarding gold mining companies, why they've lagged gold bullion. And I think it's important to highlight what he has written, because that leadership, that thought leadership, I think will start to change many boards and make decisions that will say, let's do everything to protect the value per share for the shareholders, increase the dividends, leverage the balance sheets, don't dilute all the upside with these massive equity fundings. And I think you'll see these stocks start to outperform.
Okay, so what do you think is the main problem behind the mining companies? I spoke to Kevin O'Leary a few months ago, and he said he doesn't like the gold companies because of the management behind them. Is that one of the main problems?
Well, yes, they've made all these representations of growth, and however, they've issued stock options galore faster than they found gold. They've issued more stock options than they've increased their production. So basically, they're benefiting themselves, not the shareholders. Right. So I think that that's changed, and I think you're seeing many more gold mining companies increase their dividends to the shareholders. When a little junior, Grand Columbia, rather than dilute everything to expand their production, they've come out with a silver note and a gold note, which I think is just fabulous. The silver note's listed on the Toronto Stock Exchange. The average silver stock pays a 1% yield, and you can buy this silver note with a 6% yield, and your basis for silver is $15. Silver's trading at $32, and you can buy this bond for less than $1,000. So I think that that's going to be interesting.
What's the catch there, though, Frank? It sounds too good to be true.
I think it's awareness.
Okay.
I think it's just awareness that a company like that is what Nick Holland suggests, that companies are much smarter at their use of capital in building their companies. And what's also interesting in our research is that when management buys back their stock, we have found that over time that these are the best performing stocks. So the chairman, sarah-palin, he has been buying the stock on a regular basis and has bought millions of dollars of the silver note. And so I think that is a reflection of that stock to trade higher, whereas most of these executives are so quick to issue stock options to everyone and dilute the upside.
Frank, do you think one of the problems was that we saw too many juniors appear on the scene almost all at once, or do you think we need that competition?
Well, we need to have juniors to explore and develop, but at the same time, there has to be a discipline that takes place in the use of capital. The other factor I think that's hurt many of these gold mining companies has been the number of hedge funds that have been contracting and liquidating. We found out whereas one particular company blew out $400 million of junior gold stocks last year in 1 week in December. It's very hard to recuperate from that. It's like going into the boxing ring with Mike Tyson and feel that you can automatically come back out the next day normal. That's how capital markets function. So I think it's important for investors to realize we're still seeing contraction in hedge funds. There's going to be less buyers for these juniors, and those that are buyers are going to be much more prudent, like ourselves, in examining and justifying why should I buy that management and that asset.
So someone who's getting into the gold game, Frank, do you suggest that they go into the stocks, or they should still be buying physical?
I've always suggested they have a 5% weighting in physical and a 5% in gold stocks, a particular an active gold fund manager that understands these dynamics. I think that that's what's prudent, and then rebalance each year. Because the normal volatility for bullion over any rolling 12-month period is plus or minus 15%. And for gold stocks, it's plus or minus 30%. So anytime we've had these runs of 15% up for bullion and 60% runs for gold stocks, take some profits, vice versa, have that cash when they correct, because it's normal that you buy them back.
Frank, let's quickly talk about the gold price now, rebounding today as we speak. It's Thursday after the FOMC minutes came out. Also, it seems that demand in India is going back up again. Where do you see gold headed in the next 6 months?
I think that gold will go through $2,000 over the next 6 months. And what's really interesting for your viewers is that historically, in a presidential election year, gold stocks are poor performers. The year after, the average returns are 50 to 60%.
Gold stocks.
Gold stocks.
Right.
So I think you have that factor. So then bullion trades higher, these gold stocks with better discipline management going forward, that you'll see them outperform.
Okay, why does that tend to happen?
You know what, I was talking to restaurant owners, and they were telling me that in an election year that it just is so difficult for them. It's challenging times. Right. And what we've seen in the mutual fund business is nothing but redemptions in the equity funds, except for recently high dividend paying stocks. Otherwise, this year, the stock market's gone to basically a 4-year highs. Why is that? It's a big question. $80 billion have been redeemed out of equity funds, but companies have bought back $200 billion of their own stock. That's why the market's gone up to these all-time levels. But they've been selling gold stocks, gas stocks, anything that's natural resources have been sold, that the average dividend yield today on these resource stocks, on big cap resource stocks, is higher than a 10-year government note. Right. And that's not happened since 1947.
Wow.
So it's a huge buying opportunity. Right. These companies are growing their revenue at plus 10%, paying dividend yields of 3%. I think it's the upside looks very, very favorable.
Okay, some really good thoughts there, Frank. Thank you so much.
It's great to be here.
And thanks for watching our coverage from the New Orleans Investment Conference. We'll have more for you on Kitco.com. In the meantime, you can email me any comments or questions at newsfeedback@Kitco.com. For Kitco News, I'm Daniela Cambone.